Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio. "26 years of CNBC TV18.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Prashant, with me my colleagues Nigel and Surbi. Guys, good morning.
Morning, folks. So, of course, we've had star-studded celebrations here at CNBC TV18, celebrating our 26 years. But the Bulls, I guess, need a little more, reason to celebrate because they're getting stuck. I wasn't here for the last 2 days, but I did notice that every time...
A little birdie tells me that you were having celebrations of your own.
Very, low-key, let me say. Low-key, nothing compared to what we had here. But I was, of course, watching. And, fantastic 26 years. But I'm saying the Bulls need a little more to celebrate. They're getting torpedoed every time they come to this 26,000 mark. So, Nigel, what's it going to be today?
Surbi, I've known you long enough. When you go for your anniversary to Goa, low-key and looking at the markets, nothing of that sort. Wishing you all the best and good to have you back. But, yeah, the markets need a bit of a booster shot.
Yeah, I mean, yesterday we got not a booster shot, but maybe from the lows things picked up a little bit. But the sentiment still is quite poor. There's no doubt about it. So let's just actually pick it up from exactly there, right? Yesterday, the start at 9:15 was as bad as day before yesterday. Day before yesterday was terrible. I mean, just a very, very brutal, almost capitulation-style selling all the way into 3:30 by close. Yesterday, it started like that. Down at one point 200 points, and the market advanced declines from six down to 1 up, etc. By close, it was not so bad. It was better. Market breadth was positive, 2:1 by close. So it's completely flipped. But I must say that if you just look at the kind of stocks which went up and constitute the top gainers list, and we put that list out yesterday. These are names which you don't encounter, talk about much in terms of institutional ownership, etc. So it's a bit of this and that. So we'll have to see. Basically, the focus essentially is on when things will start to stabilize. I mean, recovery and big rallies, etc. We can, even if it is a little delayed, it is okay. But you need a bit of stability first after the recent episode of brutal selling we've seen. The big cue tonight is going to be the FOMC. So the decision is tonight, and a hawkish 25 basis point cut is expected. Hawkish is what the market is expecting, right? And what do you mean by hawkish? Basically 25 and done for the next few meetings is what the expectation is. Now, on that point, Trump gave an interview to Politico, and he basically said a quick reduction of borrowing costs would be a litmus test for his choice to head the Fed. So he's making it very clear. While the market is saying 25 and done, but Trump is saying, well, the next guy who gets the job, and whether he gets a job will be his commitment to reduce borrowing costs significantly and a lot, quickly. And again, to sort of finish that thread, the next potential Fed chair, Kevin Hassett, and Trump has publicly singled him out and signaled to the market that maybe he's the chosen one. We'll see. He said last night that there's plenty of room to ease by more than 25 basis points. But it's not one man's decision, as we've always said. It's a full committee. In terms of data, which was not bad at all, October job openings climbed to their highest since May. The economy and the labor market, etc., throwing up mixed signals, and maybe a month more and we'll have better idea because it was a shutdown, etc. Maybe some impact of that. 10-year, in terms of macro markets and whether stock markets left off, absolutely unchanged. S&P, NASDAQ, 10-year real 2 basis point change. Oil prices were down about 1%. We're at about 62. Oil prices, by the way, have sold off about almost 4% very quickly in the last 3-4 trading sessions now. And I just want to put this out, which is interesting. No real immediate market impact, right? The Financial Times is reporting that Chinese regulators are considering limiting access to NVIDIA's, H200 chips. Remember, these are NVIDIA's highest capacity, the most advanced chips. And look at the flex here. Trump essentially is the one who stopped NVIDIA from selling these chips to China. Then he relented a little bit, saying, well, maybe you can sell, but we need a cut out of this, these sales to China. And now China is essentially saying, but this is Financial Times story, China is now saying that, well, we don't want these chips. They are now saying, well, they are gatekeeping and saying, Chinese firms, we will limit access to these chips. So, there's a lot to unpack there in that sense. Just to tie in the levels here, as I said, a bit of a recovery yesterday, 100-point bounce. Market sold off 200, recovered 100. 20-day moving average is 26,030. So we're still under it on the Nifty. So that's the first kind of level. If there is some recovery which continues. Nifty Bank managed to, just about managed to creep up above the 20-day moving average, and we ended slightly above it. So the 20-day is 59,149. That becomes the level. So 20-day for both the Nifty and the Nifty Bank, one slightly below, one slightly above, is the pivotal kind of marking point to note. I think the GIFT Nifty gives you a quick sense of how we're likely to open, and we'll pick it up from there. 55 points lower is what you have. Nigel has walked across with the F&O stats and positioning. Nigel, over to you.
Well, yesterday was the weekly expiry, and there were a few positive takeaways after a very, very weak Monday. So let's quickly run you through a few of them. The rupee, well, that showed some signs of stability, which is obviously a good sign. We pulled back, we ended below that 90-odd mark. Next up, the advanced decline ratio. It was the best that we saw since the 26th of November, which essentially means the number of stocks that were advancing were more than the number of stocks that are declining. You like that. The Nifty Bank, it breached the 20 DMA, but by the end of the trading session, it managed to close above the 20 DMA. And finally, the Nifty ended lower, but the India VIX is well cooled down, which sometimes is a bit of a positive sign. So those are the four positives from yesterday's trading session. What did the FIs do on the future side of things? Well, they added shorts on the index. Mild shorts out there, some unwinding of long positioning. But on the stock side, on stock futures, as you can see, they covered some shorts. And because of that, we did see individual stocks that did bounce up. Case in point could be Keynes Technologies. The stock, remember, has come out of the F&O ban. I told you about this at 10:30 a.m. itself yesterday, that was the probability. And towards the end of trade, it was almost confirmed that it's going to come out of the F&O ban. The short seems to have got stuck on the wrong side out there. So there were individual stocks that did come in for some covering out there. Moving to the clients, how are they positioned on the index itself? So you look at the clients, they are net long, 92,000 contracts on the long side, and in percentage terms as well. While the FIs, they are net short, and now the short positioning has moved in percentage terms to the highest we've seen in nearly around 2 months or thereabouts at around 89%. That combination normally is not such bad news. You want some shorts in the system? Well, your wish has been granted. Clients on the flip side, for the second day running, there is some unwinding of long positions. And we have been seeing that. They are still long on stock futures, but there is some unwinding that we're seeing out there. The PCR yesterday moved to around 0.6. And from those levels, you normally see a bounce. By the end of the trading session, it aligned itself and was closer to around 0.78 or thereabouts. So just to pull up a couple of strikes on the screen, the call writers, they still believe that 26,100 mark, they have got it covered because of aggressive writing that you've seen, in the last few trading sessions. Moving to the levels then, the broad range is 25,700 to around 26,100. That's the broad range that you're looking at. And if you're looking at, data points, then the 20 DMA comes in at around 26,030. And yesterday's low, that's going to be important. The last few trading sessions, we have been making lower lows, so you don't want that to happen. So that's the reference points on the downside. 25,700 now becomes an extremely important point. The stock that I'll be looking at is Interglobe Aviation, because post-market hours, you got news that the Ministry of Civil Aviation, they announced a 10% curtailment in Indigo flights. By the time we closed up, we're working with a number closer to around 5%. So that's a stock that's corrected 20%. I'll keep an eye out on this particular name. And also, if in case there's a penalty that will have to be announced in the time to come. But that's a stock you'll want to keep on your radar.
Yeah, absolutely. And I remember the day that the whole Indigo fiasco broke out. That's the first question we asked the analyst, whether this is going to develop into something more severe, whether Indigo is at the risk of losing some of its slots. And that's exactly what we are grappling with today, as their capacity has been cut by 10%. So Indigo remains a stock in focus. By the way, don't lose sight of all the primary market action. Never a dull day, right, in IPO land. And today, while of course we'll start off by looking at Meesho's listing today, and what a bumper subscription this issue got, almost 80 times. And the anticipation is that it's going to be a good listing. It's not the only one. I mean, there are, it's got peers, Equus, Vidya Wires. These are the ones that are listing today. There are more IPOs opening. Park MediWorld, we'll be speaking with Park MediWorld actually in just about half an hour from now. There's Nephrocare Health opening out. And then there are some closing today. So Wakefit Solutions is closing today, Wakefit Innovations, and Corona Remedies. Never a dull day in the IPO market. The only caveat, by the way, is that if you thought December will be the lucky month that will reduce the amount of FII selling, that's not what's happened, because FIIs are going back to selling in a big way. The highest sales since September. So watch for that. That's been a bit of a area of concern. Maybe once they go on their Christmas holiday break, the FPI selling stops. Anyway, before we introduce our first guest on the show, quick glance on Asian screens, and things are pretty mixed out there in Asia. We've got inflation numbers out of China, and that's suggesting that deflation at the producer price level, that is continuing, while CPI, consumer inflation has been spiking in China. So keep a watch on that. Mixed picture across most of the Asian equity markets right now. Let's pull up the implied open and the GIFT Nifty, see what that is suggesting in terms of how might we start. Can the bulls continue to claw their way back? 54 points lower, so cautious start is what is expected for now. Well, as promised, let's get to our first guest on the show. Mark Franklin, Deputy Head of Multi-Asset Solutions at Asia at Manulife Investments is with us. Mark, great to have you in. Thank you so much for joining in. So let's start with the big Q. I think markets the world over are anticipating this 25 basis points rate cut from the Federal Reserve. What does that signal? I mean, it's been pretty much a Goldilocks scenario for the US market, right? Growth is okay, inflation hasn't spiked, the Fed is cutting. So we keep rolling into the new year on a positive note then, as far as the US is concerned.
Good morning. We'll have to wait and see to what extent the narrative around the policy decision is trying to strike a balance between being guarded somewhat for inflation, but also fulfilling their full employment mandates. The market's expectation is probably for a hawkish cut, as in Chair Powell effectively highlights that there'll be data dependent from here on in, and that one shouldn't expect the rate cut cycle to be on autopilot. It will be meeting to meeting. And so you might see the dot plot remove a cut from next year. Then the question is whether the market reacts to that, whether the market holds its ground and still expects 2 to 3 rate cuts next year. The bigger question really, though, is that the fiscal side is really a case of attempting to run it hot. Large fiscal deficits, pro-cyclical policy, and then the extent to which the monetary policy side will try to facilitate that or lean against it because they're concerned around the risks of inflation starting to move back higher again. If you look at bond markets in the US, they're starting to discount that prolonged period of large fiscal deficits, a bit of rising term premium, higher yields, and in fact also the fact that some of the more recent data, which we've been starved of, has come through quite solidly as well. So there is reason why the Fed may not want to indicate that there are many more automatic cuts to come, but it's going to be about threading the thread through the eye of the needle in terms of placating concerns around a retightening of financial conditions.
Mark, hi, morning. This is not a normal president, right? President Trump is unlike any other, you would agree. He's openly, and just look at what is, even as the FOMC is expected a cut and everyone is saying, well, maybe it's going to be one cut and then we'll see. In an interview to a newspaper magazine last night, President Trump essentially saying, well, the litmus test for whether who gets the job as the Fed chair is going to be how fast, how deeper rates can be cut. Now, Kevin Hassett, who's seen as a front runner, echoed that sentiment just last night, saying, well, a lot more room for more than 25. So as we enter 26, it's going to be, if we're going to actually see that they're going to be able to force their will upon what the Fed does. I don't know if they can. The market will have to reprice. I just wanted your thoughts.
One of the things that we're grappling with at Manulife is the extent to which whether the market will somewhat look through the policy decisions that we get at this meeting and maybe the next meeting and start to really discount the post-Powell Federal Reserve from the second half of next year onwards, because the expectation will be that whoever is in place as chair, and to some extent the composition of the voting committee as well, will probably pivot to a more dovish stance. And therefore, does the market really care so much about what the policy decisions are now and the discussions around that? Does it care more about discounting the likelihood that the complexion of the committee, as well as the chair, will change from the second half of next year onwards?
Okay. All right. Mark, good morning and good to see you, Win. I recall you saying that you're seeing some kind of stability in the Indian markets, but you're still neutral. You're holding on to that stance, or do you believe 2026, India could be one of the top performers post the kind of measures that have been taken by our central bank, our central government as well, and earnings in all probability, I live in hope, it's going to pick up next year?
Yeah, if you look at the sort of the drivers of performance within Asian equity markets this year, those markets that have done best, so for example, Korea and Taiwan, they've generated their returns from a combination of a strong earnings cycle as well as valuation multiple re-rating. Now, those markets are probably closer to the upper end of their historical trading ranges, and therefore, as we roll into next year, the low-hanging fruit in terms of multiple expansion is probably a lot less than it was at the start of this year for those types of markets. So then it all comes down to the extent to which earnings growth and upward surprises around earnings momentum can catalyze fresh buying flows into those markets. And India is roughly in that camp as well. There's probably not a great deal of room for valuation multiples to expand. And then it comes down to the extent to which the earnings cycle and the growth cycle from a macro perspective surprises to the upside. Now, one incremental risk at the margin for India, which I think is the reason why the market's been held back a little bit in the last 1 or 2 weeks, is the question mark around sourcing of crude imports and the extent to which that mix will have to shift away from Russian crude imports towards higher priced imports. And that then affects the current account position. And therefore, that's why you've seen some currency weakness. And then if you think about foreign investors, they're looking at in dollar returns or equalized currency returns across all these markets. Well, so the currency is an important component as well as the local market currency returns as well.
Quick last point to just go back to the Fed, Mark. When all this started, the market I remember the volatility, right? When it first dawned upon the market that White House seems to want to call the shots at the Federal Reserve. But now as we get into that second half of next year, which you alluded to, will the market be happy with the dovish Fed, or do you think the market will have an issue realizing that the White House's dominance on the Fed is for real?
Well, I mean, one sort of scenario you could paint is to say that the front end and shorter duration equities respond well to a dovish leaning central bank, which is then aligned with very easing fiscal policy. But on the flip side, the longer end could continue to see higher yields as a result of rising term premium, but also rising risk premium as well. And so that's a scenario where the markets will be able to have their cake and eat it in terms of creating investment opportunities across the curve. And then that has implications for which factors and styles within equity markets do well or struggle a bit.
Okay, well, I think we can safely then say that 2026 is likely to be a very, very interesting year, especially for the US bond and treasury market. Thank you, Mark, very much for joining in. Appreciate you taking out the time today. Well, with that, let's tell you what else we've got lined up for you on the show. At 8:35, we'll have the management of Park Medi World. The issue is opening out for subscription today, so we'll find out a little more about the company. At 9:20 a.m., Macquarie Capital's Aditya Suresh joins in. He's our market master of the day. At 9:35, the management of IKS Health is going to be with us to talk about the second half outlook. After that, the management of Anupam Rasayan joins in at around 9:45. The company has signed a definitive agreement to acquire a US-based specialty chemicals company. So we get to the details of that. Towards the end of the show, Lata will be in conversation with Enam Holdings' Sridhar Sivaraman on the impact of lower nominal GDP on earnings and what stocks may do in 2026. So stay tuned for that.
Time to slip into a short break, but we've got a lot of stock-specific action to track for you in our special Top 10 segment. We focus on that after the break. We're looking at Anupam Rasayan, AU Small Finance Bank, IRB Infra, NLC India, Cyrus Life, Grasim, and Graphite India. They'll be reacting to positive news flow, while Swiggy, Indigo, and JSW Energy will be reacting to negative news flow. Take that break, come back, we get into further detail on all of those names.
Well, before we get into that break, here's the equity call of the morning. So let's quickly run our viewers through this one. It's coming in from Citi. Surendra Goyal of Citi says that 2026 will start from a better risk-reward standpoint relative to 2025, as India has already sharply underperformed. Other EM's portfolios are significantly underweight India. As such, key variables are getting or should get better, he says. Earnings trajectory is stabilizing with conviction increasing in low double-digit earnings growth trajectory. AI trade globally has been a bit more volatile recently with more questions being asked, which should lead to more broad-based performance in the next calendar year. That should benefit India. A favorable US trade deal for India could help reverse the 2025 underperformance. Their December 2026 target for the Nifty is 28,500. Key overweights include banks, telecom, autos, healthcare, and defense.
"26 years of CNBC-TV18. 26 years of CNBC-TV18.
Welcome back. Well, the picture across Asia is a little muddled, one would have to say, and the GIFT Nifty has been telling us that we'll probably have yet again a bit of a cautious start. Some of those markets are trading slightly lower, so almost 60 lower on the GIFT Nifty. We'll see if the bulls can indeed fight back today. Well, there are plenty of stocks to focus on, so let's straight away get to our list of top stocks to watch. Our entire team is standing by with the details of the day's likely action. Mangalam, let's kick it off with Swiggy. They've got the shareholders' approval to go ahead and raise, 10,000 crores, right? Equity.
Yep, it is 10,000 crores. That's what they're mopping up. The QIP opens today. The indicative floor price is around 371. The board approved price is close to around 390 rupees. The board had approved QIP worth 10,000 crore rupees along with their results in November itself. And remember, the company had already raised about 4,500 crore via fresh capital in November 2024 via an IPO at 390 rupees. So 1 year later, they are raising funds, and now the indicative price is close to 371 on the floor price. So expect the stock to open in the red. But thereafter, depending on the demand and depending on the prospects going forward, we probably may see some recovery. Why do I say that? Because post Rapido stake sale and QIP, Swiggy will now have 17,000 crore cash, which puts it in line with Eternal, which has around 18,300 crores, and Zepto as well. Reports suggest they have about $1 billion in cash as well. So this is basically a fight for mopping up the war chest more than anything else. And all of this comes at a time when Albirna Dhinsa also did say that, QCOM is near bubble territory. So opens in the red. Thereafter, we may see some recovery.
And it'll be interesting next 3-6 months, right? Swiggy's lost a fair bit of share. So are we going to see kind of a discount-led spending blitzkrieg to regain some of the market share? It's an interesting one to follow. Mangalam, thanks very much for that. Anupam Rasayan is the next one we want to focus on. Sonal has got details on this one. Sonal, good morning.
Good morning, Prashant. Well, Anupam Rasayan has gone ahead and made an acquisition in the US markets, 100% equity in Jayhawk Fine Chemicals, which is a US-based specialty chemicals company. The total consideration is $150 million, and they're also taking $16 million of cash from Jayhawk. So the enterprise value is $134 million. How will it be funded? Well, Anupam Rasayan, through a wholly owned subsidiary, will be investing $40 million, and an investment firm will be investing the rest $110 million via the wholly owned subsidiary of Anupam Rasayan. What we need to understand is whether there are any IRR commitments, any dividend commitments that Anupam Rasayan has with this investment vehicle. The company says that the total revenue after consolidation will be 2,183 crore rupees, that is around $243 million. The EBITDA will be around 550 crore rupees post-consolidation. It will also be EPS accretive and give them access to US markets and more different chemistries as well. So the valuation stands at 8.9 times EV to EBITDA, which compares with global companies trading at 3 to 30 times EV to EBITDA depending on chemistries. So it looks like it is in the range. The stock will be in focus today.
All right. Thanks a lot for that, Sonal. And in fact, we'll be joined with the management at around 9:45 a.m. to talk about this particular acquisition and to understand in further detail. Keep in mind, stock is up 20% just in the last 1 month. But the one that will continue to be in the news will be IndiGlobe Aviation's some relief for customers and hopefully shareholders as well. Sudarshan joins us to help us out with what's the latest on that front. Morning, sir.
Morning, Prashant. Morning, Nigel. I'm going with red for Indigo today because yesterday afternoon there was an order from DGCA that they had asked company to cut the number of flights in the winter schedule by 5%. But late in the evening yesterday, that was increased. Now company has to cut the number of flights by 10%. So what exactly it means? So in the summer schedule, total number of daily flights for Indigo was in the range of 2,100 to 2,200. If there was a cut of 5%, the daily reduction would have been 115 to 130. But now with 10% cut, the range of daily reduction goes to 220 to 230. And now in the winter schedule, they are going to have the flights, number of daily flights in the range of 2,000 to 2,100. And that would be even less than what they had in the summer schedule that was in the range of 2,100 to 2,200. But there was a positive commentary came from CEO. He has said that operations have largely stabilized. Yesterday, they had almost 1,800 flights, and today they are going to fly almost 1,900 flights. On-time performance, it has improved, and now it's almost near to 90%.
Okay, all right. Thanks very much. So for that, well, that's Indigo for you. Moved up. That commentary came around closing time from the CEO, and that spike that you see was in the back of it. Well, stocks with news flow. Vivek is here with that. Vivek, morning.
Well, good morning. Quite a few stocks on the radar. First on the list is AU Small Finance Bank. The company has got the approval from the Department of Financial Services, Ministry of Finance, to go ahead and increase the foreign shareholding in the company from 49% to the maximum permissible limit of 74%. While this is largely a procedural nod that the company has received, what this essentially means is that the company will see a weight up in both MSCI and FTSE in the upcoming index reviews. The other stock on the radar is NLC India. This is a significant development. Remember, the company's almost 1.9 gigawatt Ghatampur thermal power plant, which had one unit operational. Last evening, the company has managed to go ahead and operationalize the second unit as well. This is a 660 megawatt unit. The company says that the third unit too is on track to get operationalized by the end of FY26. What the company says is that this particular project will alone contribute a little over 8,550 crore to the top line once all three units get operationalized. Lastly, having a look at JSW Energy as well, GQG Partners last evening sold, in yesterday's trading session, sold close to 0.9% stake in the company. This was done at an average of 444 rupees per share. This was done via a block deal. Remember, GQG held close to 1.8% stake in the company at the end of September 25. Other than that, the management has also given an update to the exchanges saying that there will be a board meet on December 12th, and they will consider raising funds via issuance of shares or warrants. Also, a QIP is on the radar for this particular fundraise. And lastly, I just missed out on mentioning IRB Infra as well. The company, along with its InvITs, has gone ahead and seen an increase of close to 16% year-on-year as far as the toll collections are concerned.
Okay, all right, Vivek, got it. Thank you very much for all the details over there. We'll keep these stocks on the radar for sure. Ria is joining in. She's watching out for a bunch of names this morning as well. Ria, good morning. Tell us more.
Well, good morning. Starting off with Zydus Life, which has partnered with Formicon for an exclusive licensing and a supply of a biosimilar to Keytruda in the US and Canada. Now, this marks the company's entry into the North American biosimilar market, debuting with an immunotherapy product, and the BLA application for the same is expected to be submitted to the US FDA in the near future as well. Moving on to Grasim, this one will be in focus since Global Infrastructure Partners, which is a part of BlackRock, is going to invest up to rupees 3,000 crores or roughly $335 million in Aditya Birla Renewables, which is a wholly owned subsidiary of the company, for a minority stake. Now, there's a commitment of 2,000 crores, and with the green shoe option to invest another 1,000 crores going ahead. Now, this investment translates into an enterprise value of roughly 14,600 crores for the company. And in terms of the portfolio of the company, the current renewable energy portfolio stands at roughly 4.3 gigawatts. And going ahead, the company is targeting a capacity of over 10 gigawatts going ahead. The last stock that we are talking about today is Graphite India. Now, the company has announced a partnership with Kivoro, an exclusive partnership to commercialize graphene-based heat transfer additives, or HTAs, in India. And under this agreement, the company will become the exclusive distributor of Kivoro's HTAs across India, and they will be focusing on the deployment within the corrugated paperboard sector for the product.
Okay, all right, Ria, thanks very much. So let's quickly recap our list of stocks to watch today. The ones that have positive news flow around them would be Anupam Rasayan, AU Small Finance, IRB Infra, NLC India, Zydus Life, Grasim, and Graphite India. Stocks with negative news flow would be Swiggy and Interglobe Aviation, along with JSW Energy. So that's the stock list for the day. But let's now figure out what's happening in the world of commodities. We have Manisha Gupta joining in with a roundup of all that action. Manisha, usually we always sing Sona Kitna Sona Hai. Now we have to sing Chandi Kitni Chandi Hai. What headlines? I mean, $60 on silver.
Oh, well, yes. And that's a 4% up again in the overnight market and 111% up in the international markets. For the Indian markets, of course, with the rupee depreciation, we are trading 120% higher for this year. So, well, it absolutely has been an amazing year for silver prices, where almost everything seems to be coming together to push the prices higher. And we perhaps are not done yet, because with the kind of fundamentals that we are working with, the street anticipates that you could be looking at higher highs in 2026 as well. The ETF inflows are the highest in last 5 years. We have the market focus coming in for silver being added as a critical mineral list, and also the kind of usage that silver has in industrial demand, data centers, solar panels, all of that seems to be keeping the prices higher. But it's not just silver which is trading at all-time highs. Copper also has hit a record highs of around $11,700 a ton, 34% of gains in this year, and strong demand coming in from power grid upgrades, computing power, inventories, and mining shortages. Also, the decline that we have seen on exchanges on LME and COMEX, all of that seems to be supporting copper as well. So two metals trading at record highs right now in Asia. One is silver, other is copper.
Okay, all right. Thanks a lot for that, Manisha. Well, time to slip into a short break. On the other side, we'll be joined by the management of Park Medi World, who will be joining in to talk about their IPO that opens up today.
Of CNBC-TV18. "26 years of CNBC-TV18.
Well, as promised, let's focus on the IPO corner then. We have Park Medi World, which operates the Park hospital chain across North India. That opens up for public subscription later today. The company is looking to raise 920 crore rupees. The price band is fixed in the vicinity of around 154 to around 160 rupees per share. The IPO, well, to give you a brief detail about the breakup, it comprises of a 770 crore fresh issue and around 150 crore offer for sale. To understand the utilization of these proceeds and the way ahead, we're joined by Mr. Sanjay Sharma, the Group CEO and Whole-Time Director. Good morning, Mr. Sharma. Thanks a lot for speaking to us here on CNBC TV18 and wishing you all the best with this particular issue.
Good morning, and thank you so much to you for inviting us, sir, and thank you so much for your viewers to listening to us.
Well, it's a pleasure, sir, and they've all tuned in. So let's get a couple of details out of the way. 770 crores is what's going to be coming back to the company. That's the fresh issue. Out of that, I understand that 380 crores is going to be used for debt repayment. Fill us in with a brief detail. Post this repayment, what is the net debt number likely to look like? Point number one. And since you're paying up close to around 380 crores, interest saving will be in the vicinity of 35 to 40 crores or more?
Yeah, roughly, sir. See, the criteria is currently the entire debt is about 425 crore, which is from the banks. And we have an FD, which is unencumbered, about 305 crores. So total debt roughly turns out to be about 125 crores, if effectively we see. But post IPO, we are looking at retiring about 380 crores from that. And the capex amount, what we intend using for equipments and others is about 88 crore. And general corporate purposes is what we are keeping for about 302 crores.
All right. So basically, you'll become a net cash company post this IPO. Is that correct?
Yes, sir.
And I guess you'll be paying interest only on the 150 crores. So effectively, the interest saving will be around 15 crores approximately. Will that be fair to say?
Very right, sir.
All right. And you're saying that some part of the money is going to be used for capex as well. I understand that the number of beds has moved from around 2,500 to around 3,250. You can update me on what's the recent number. And what is the target capacity that you're looking at? And will it be mostly in North India, or are you looking at spreading your wings a little bit more and going more pan-India?
Okay. Currently, we are present in North India in 4 states, and with the bed capacity of 14 hospitals and bed capacity of 3,250 beds. But we are looking forward to increase the bed capacity. Roughly, if I tell you, 300 bed capacity in FY26, 750 in FY27, and 600 in FY28. So the total bed capacity increment will be about 1,650 beds, and the total number will be 4,900.
Okay. And the last point, which my colleague asked, in North, or will you spread out as well, sir?
Okay, so currently we have large scope in north of India. Our approach of expansion is basically in a cluster format. So we look forward to first consolidate in North India initially. And currently we are present in 14 districts. There are about 174 districts which require a model on the affordable side like ours. So we intend to first consolidating in North India and then subsequently spreading our wings to East, West and South.
Okay, there's enough scope there. Mr. Sharma, morning, Prashant here. You know, two things. One, a revenue growth over the last 3 years is about 5% CAGR or something, right? I mean, so it's kind of tepid. Just, I mean, on that, if you can comment. And what is the dependence on CGHS and government patients on government schemes? I think that is very high, right? And is there a issue then with regards to when, when the money comes in from the government? What are the dependents first?
The criteria is this, that our payer mix currently is about 84% coming from the government insurance and 16% coming from private insurance. The distribution payer mix is such. But out of 84% also, 92% is from the central government. So which is like a sovereign bond. The payment cycle is about 4.5 months, and it is a very structured, formatted system, which is faceless, contactless, without any human intervention. And automatically the flow comes across in that manner after 4.5 months.
But Mr. Sharma, on CGHS, so it's good to know that you don't seem to be reporting any payment delays or any backlogs. You're saying within about 4.5 months, the money comes in automatically. But yes, what's important to note as well is that CGHS has finally hiked rates after many, many years. And it's a pretty broad-based hike across procedures. How does that change your operational dynamics? Give us some sense, because your dependency is as high as 83-84%. What has this latest hike meant for you?
See, generally the central government hikes the rates or change of rate happens in about 2.5 to 3 years. But as you mentioned, you were very right. This time the hike has been substantial, nearly about 12 to 15%. But in our FY26 numbers, we have not factored in this number till yet. But subsequently, we will be having definitely good appreciation in the EBITDA otherwise.
So will the appreciation be to the same, I mean, roughly, I know there's a very broad kind of, way of looking at it. The added, thrust would be in the same vicinity of, say, 15%, because that's how much the hike has happened. You're saying 15-20%.
We'll be looking at it conservatively. We'll be looking at about 7.5%, just on the conservative side.
Okay. So in FY27 EBITDA, 7 to 7.5% of a kicker will come in just by way of the CGHS hike. The rest, of course, will depend on your operations and, what happens.
And the growth potential.
So just, what is your strategy going forward? Because the share of insurance right now is very, very low in the business. Share of insurance, I think, is just about 7.5%. Are you looking to change the mix?
Yeah, ma'am. As we are going forward, see, our growth verticals are 4, in fact. In the process, we have 14 hospitals which are at different maturity cycle. So the hospitals which are younger in age and where the occupancy is about 50-55%, the growth will come by ramping up the occupancy. In the hospitals which are matured and there is 75 to 80% of growth, the growth will come because we have taken a conscious decision of laterally shifting towards high-end tertiary and quaternary product mix like robotics. We are doing about 30-odd robotic surgeries in a month. We are doing about 650 cardiac interventions. We are doing about 350 assisted joint replacement and others.
Right.
And I'll just finish, sir, if you give me a second.
Yeah.
The third growth aspect will come from greenfield, and the fourth will be from brownfield acquisitions. So that will be the growth aspect which we'll carry forward.
Got that. Mr. Sharma, we'll leave it there. Thank you very much. Appreciate you coming on here on CNBC-TV18 and running us through some of the details with regards to this issue. Open all the best to you.
Thank you so much. Thank you so much. It's always a pleasure. And thank you to your viewers also and to you also for inviting us.
Thank you very much. We'll take a break. Deven Choksi of DR Choksi FinServ on the other side for some fundamental stock conversation. Stay tuned.
26 years of CNBC-TV18. "26 years of CNBC-TV18.
Welcome back. Well, let's get to Hormuz, look at some of those delivery stats, interesting trades from yesterday, and then we'll introduce our fundamental guest as well. Hormuz, good morning. What did you keep on your radar? What caught your eye?
Oh, morning, Surabhi. What's catching everybody's eye right now is Keynes Tech, right? The extreme price moves that you're seeing over the last few sessions. Today, the stock is out of the F&O ban, so that's the big news. But of course, in yesterday's session, it snapped a 4-day losing streak. It was the biggest single-day gain since November of last year. And Tuesday's volumes, as we had mentioned yesterday as well, were the highest during this 28-day bearish phase that it has had over the last month or so. The delivery volumes, though, yesterday on the rebound were much lower than what they were during the fall that the stock saw. Now, over almost 2 crore shares were traded yesterday, 20-day average of around 17.5 lakh. Only 18.6 lakh shares marked for delivery. The 20-day average is around 5.5 lakh. You took the stock from 800 to 8,000. That before 2025, the 25 preceding months, the stock had declined in only 2 of them. Now, Eris Life Sciences was another one. The stock snapped a 10-day losing streak yesterday. It was down 9% during this 10-day fall, and it recovered all of that yesterday. It was up around 11%. And the biggest single day gain since February. The volumes were the highest since 2019, and they were the highest since they were the sum total of the last 46 sessions put together. Almost 40 lakh shares traded, the 20-day average of only 80,000 shares, and close to 4 lakh shares marked for delivery, the 20-day average of around 41,000. And Concord Enviro Systems was one more name on the list yesterday. The recent listing snapped a 6-day losing streak yesterday, the biggest single-day gain since Jan. Volumes were the highest since Feb as well. 9.5 lakh shares traded. The 20-day average is only 34,000 shares. And out of those 9.5 lakh shares, only 94,000 were marked for delivery. The 20-day average here is only 21,000 shares. So the stock, though, has been an underperformer, down around 45% from its IPO price.
Okay, all right. Thanks a lot for that, Hormuz, for joining in and running us through that neat list. Well, let's welcome Deven Choksi, MD at DR Choksi FinServ, who joins us on the show. Hi, Deven. Good morning. Good to see you, and as always, let's focus on the top stock that everyone's discussing, both customers as well as shareholders, Interglobe Aviation. 20% down from the top. Still the market leader, still had some tailwinds as well. The street will be a little bit skittish how they wiggle their way out of this one, because there could be a penalty as well that could come about. That's the fear. Your view on the stock at around 4,900 rupees?
Yeah, Nigel, good morning. Well, I believe that I think there are not many moving parts at this point of time as far as I think the predicting the stock price is concerned, and the likely impact onto the bottom line of the performance of the company is concerned. Last quarter hasn't been so good for the company. I think they reported losses. This quarter, I think this exceptional item, I think how much it will have a dent on the P&L is difficult to quantify at this point of time for us. But I believe that I think the worst is still possibly not over. I think the kind of structural changes that the government is forcing in, probably I think it may have a telling impact onto the operations of the company. Whether I think the main routes are basically I think altered. The key routes I think where the company is operating their sole operator, I think they are not altered, and I think they continue. So over there, they may end up, I think, charging slightly more premium prices. But on the main routes, possibly, I think, with the 10% loss in share, I believe that I think it's going to be a little bit of a challenge that they might be facing. So let's see how exactly the revenue front, the costing front, or the cost front, I think, is getting affected in this quarter. So as of now, no view. We will wait and see for some time.
Got that. Devin, thanks for joining us. Morning. Keynes is the other one, right? Two stories, 2 stocks which you've seen was happening concurrently. One, of course, Indigo. The other was Keynes. A sharp price drop. Yesterday, of course, came back some 13% by close. What do you make of this one?
Yeah, Prashant, good morning. Not too sure about, I think, what inspired buying, I think, for the buyer yesterday. However, the company has clarified that, yes, I think there has been an error on the accounting front. I do not know, once again, I think, what kind of impact it will have on the P&L side. We haven't interacted enough with them. But I believe that I think this is not going to be taken very easy. As such, I think the valuation-wise, the stock is already commanding a premium. And in case I think the profit picture is missing for at least 1 or 2 quarters, possibly I think this premium valuation might get affected. And that's the key. I think one will have to wait and watch for some time, particularly because there is less amount of margin of safety at this point of time due to the premium valuations.
Okay, all right, got that. Devin, hi, morning. So never a dull moment when you're talking about quick commerce or these platform companies, right? Meesho is listing today. I don't know if you had a chance to take a closer look at the business. Give us your thoughts if you have any. And then the comment from the Blinkit CEO is very interesting. He was saying that this kind of cash raising, and Swiggy is raising cash, right? They're doing a QIP for 10,000 crores. So the Blinkit CEO said that this kind of fundraising may not be sustainable. Your thoughts? Meesho, Swiggy, Eternal itself, any of these companies?
Yes, Sylvie, good morning. Particularly for Meesho, I guess I think the moat is missing. I think you have a tier 2, tier 3 city model. At the same time, I think you are not a commission charging company. You are basically generating your revenue from the advertisement. And I think you're trying to create the space for yourself in this particular space of e-commerce. Not completely sure, I think, how exactly you can have a run rate continuing in this manner. Especially, I think the moat completely missing on that particular side is because I think the kind of brands also would be available on the platform. They are more affordable brands. So obviously, I think the class of customers that you are catering to are also coming from the smaller cities, etc. I don't see, I think, any immediate change in the business model happening for this company. And that's where probably I think I would be a little bit circumspect. Though the valuation-wise compared to other companies, I think it may be slightly quoting at a cheaper valuation, particularly in price to sales ratio that we look at. But otherwise, I don't think that I think immediate amount is available. As far as the quick commerce is concerned, yes, I do agree that I think this kind of money which is being earned right now, right in this point of time, cannot be sustaining. And that's where probably I think one will have to be very mindful about investment into this kind of companies. Because I think the taking market share is one aspect, but I think running the operations on a profitable basis is the most important aspect. And that's what investors are going to be asking for. Today, I think at the market cap valuation that you see for these companies, I think they are richly priced. And today, I think if you have to even factor 8% yield into them, probably on market capitalization, probably I think you will be asking for a significantly large amount of profit production by these companies, which I don't see immediately happening at least in the next 3 years or so, given the business model that they have. I would rather wait. I think I'm not in a hurry. I think as a consumer, you enjoy their services, but not as investors.
Okay, all right. We'll take a break. Devin, stay with us. We're going to come back in just a bit from now. The pre-open session is 4 minutes away. Stay tuned.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Okay, welcome back. Market pre-open is kicked off. 25,900, about 0.25% higher at this point. But okay, I think I think we are getting the first rates. Okay, the clock was to the market open, the actual market open. The pre-open is kicked off. 70 points and 15. It'll settle down in a bit from now. Well, let's get technical trades out of the way. Sudarshan and Mitesh are with us with what they'd want you to do. Gentlemen, good morning. Great to have both of you here. Mitesh, you go first. 200 down at the intraday low yesterday, 100-point recovery. Nifty bank creeping and closing above the 20-day. What are the trades?
Morning, Prashant. I think that was the most important event yesterday. Somehow the market managed to hold on to levels about 25,800, 780. And that's the level which I'll keep a watch upon today. In case we start breaking below that, then we'll pencil in for more correction. Otherwise, we are in that range of 25,800 to about 26,300.
Got it. Okay. All right. Good morning, gentlemen. Sudarshan, what about you?
Yeah, good morning. It's almost the same. 25,800 is a support level. that breaks and then a bearish chart pattern comes into play. Now, yesterday that recovered. Therefore, intraday breakages should be ignored. If the market closes below that level, then clearly a downtrend is signaled of 300 to 400 points. There's something else. We are also in the middle of a lot of unknown news. Suppose an agreement comes about with the US, suppose there's a ceasefire in the Ukraine war, then the markets can turn on a dime. So if you take short positions, be properly hedged.
Okay, got that. So that 25,800 mark is very, very important. And if there is some good news, maybe we see a bit of a melt up. So let's see how that goes. But individual trading ideas will continue to present themselves. Mitesh, you go first. What's on your radar?
Morning, Nigel. I have a mix of buys and sells. On the buying side is Policy Bazaar. It's been a call in the last few days, and even now can be bought with a stop at 1935 for a target of around 2,000. Lupin has given a pullback, so that's a buy with a stop at 2034 for targets of 2085. And on the selling side is Tata Steel with a stop at 163.75 and a target of 153. And ICICI General Insurance, or ICICI Lombard, is a sell with a stop at 1967 for targets of 1900.
Sudarshan, what about you?
Well, JSL is a buying opportunity with a stop under 760. It's been an outperformer. Marico is a buy with a stop under 715. Again, FMCG perhaps is giving a different view. It's slowly, steadily moving up. CESC is an intraday short with a stop above 190, and Petronet is an intraday short with a stop above 275. The markets are choppy and unknown.
Okay, can we just show all the... Sudarshan, apologies, we couldn't keep pace with the stocks. Can you just... Can I request you to just repeat those again? We want to put the stocks up for our viewers' sake. Go on.
JSL is a buy. Marico is a buy. CESC is an intraday short, and Petronet is an intraday short.
Okay. Those are the two longs and two shorts coming through from Sudarshan this morning. Thank you very much, Sudarshan and Mitesh, for joining us. The big question, of course, which is on everyone's mind at this point is, when will the market stop, in a way, hemorrhaging, right? I mean, when will this steep sell-off and the damage in broader markets stop? And then, of course, we can talk about some repair and recovery once that stability starts to come through. So here's a whole host of... okay, what we'll do is we will play out some sound bites on that in just a bit from now. But for now, let's go across to some brokerage, what brokerages are saying, and some stocks in focus there. So over to you.
So Kotak Institutional Equities has initiated coverage on LG Electronics, and the call is reduced and target is 1,600 per share. It says that company maintains leadership position in competitive market led by brand equity, well-entrenched distribution, and the launch of affordable appliances, new category and export will and the ramp up of that will boost the growth. But at current market price, it believes that the stock is fairly valued. It forecasts 10% revenue and EPS CAGR over FY25-28. Goldman Sachs has written note on Nestle India. It maintains neutral call but has increased target price to 1,230 per share. It says company will likely sustain growth momentum with support from GST rate cut that recently government had announced. Lower GST enables company to viably compete at key price points and regain market share. Affordability gains in coffee and chocolates will support faster demand, but valuations appear stressed, and that's leading to a neutral rate despite growth momentum that company likely to see going forward.
Okay. All right. So thank you very much for that. So we'll keep those stocks on the radar as well, Nestle and LG Electronics. But now, as promised, let's get you a slice of all the market opinion. We caught up lots of market veterans and experts, including Sameer Arora of Helios Capital, Vikas Khimani of Carnelian Asset Management, and Ashish Gupta of Axis AMC to understand how investors can navigate this choppy market.
Right now, it looks like somebody is giving up on India in terms of selling. I guess I would call it indiscriminately. This looks more like dumping. Now, many people say that some of the PMSs, which were exclusively or mostly into small cap stocks, are shutting because they have been doing badly for 1 or 2 years or 2-3 years. Not sure what the story is. But in general, today doesn't look like a day from which you should draw a conclusion that somebody is seriously looking at it and has decided after the when the year is about to end, that this is the time to sell?
This year, FIs have been seller, but the net sell is about 17-18 billion dollars, right? If you look at the context of the supply, the IPO supply this year is going to be about $20 billion. And the secondary stake supply is, as I said, about $40 billion, about twice that, right? So the total supply is about $55-60 billion compared to about $18 billion of FII selling. So the larger headwind to my mind is coming from that supply rather than the $18 billion of FII selling. Compared to last year, the retail participation in primary issuances has moderated. And increasingly, you are also seeing, compared to last year, the valuations being demanded in many of these issues coming down. And some of the multiples have been scaled back down by about 30-40%. So if the primary market multiples start coming down, that is going to reflect in the secondary market, right? Because it's an arbitrage. So why will a similar company in the secondary market trade at a higher multiple if in the primary market it is coming at 20-30% lower valuation?
I've heard is that there was a little bit of margin funding selling which came through, especially from the retail investors, is what I've heard, but there's no way for me to verify that. And I think broader market trend, as you rightly said, has been there for some time. Large caps have been, kind of leading this rally in last, couple of months. To my mind, nothing changes. Market continues to remain sort of one of the most promising market. It's a stock pickers market. That's where we always focus. So I think that journey continues. And these kind of times only give you more opportunity to look at interesting ideas, which otherwise, in bull market, you don't get at a good price.
Okay, so that was a lot of market opinion on the near term and the medium term and what lies ahead for the Indian market. What lies ahead today is a quiet start. The Nifty is settled with about a 24-point gain, which is not too bad, considering that cues across Asia have been fairly mixed. Lots of stocks in focus. Swiggy, which is doing that large fundraise. Swiggy is down about 0.7% at this juncture. Let's also pull up Interglobe, a stock that has been really volatile, most in news. Interglobe is about 0.5% lower right now. In fact, let's revisit the latest developments on Indigo. The government is now saying that Indigo will be cutting back as much as 10% of its flights in the winter schedule. So let's revisit the numbers.
So I'll focus on 3 points: DGCA's recent order, company CEO's statement, and the trading volumes of yesterday. So first, talking about the DGCA's order, yesterday afternoon, DGCA had asked company to cut the number of flights by 5%, but late in the evening, they have revised the order and now has asked the company to cut the number of flights by 10%. And with this, the daily reduction now increases to almost in the range of 220 to 230. And if there was a cut of 5%, it would have been 115 to 130. Now, CEO has said the operations have largely stabilized. Even on-time performance has improved. It's now near to 90%. And today they are looking to fly almost 1,900 flights versus 1,800 they had flown yesterday. Now, talking about the trading volumes for the second straight day, total trading volumes were more than 1 crore shares. And that is against 20-day average of just 12 lakh shares. But delivery percentage to total trading volumes was just 32%. That was lowest since December of 2024.
Okay, all right, got that. So thanks very much. So Interglobe on our radar. Right now, the stock in free-open is up about 0.5%. The other big news maker, Swiggy, in the market, looking to raise 10,000 crore rupees. Mangalam, let's revisit what we know.
Yep, in pre-open, the stock has settled slightly lower, closer to the indicative, the announced floor price at 390. The indicative floor price, as our colleagues gather, is close to around 371 rupees. There are two factors that will, have polarizing effect on the stock. The one on the lower side would be the fact that there is, a fundraise at 371 rupees less than a year after the company has raised about 4,500 crore rupees via a fresh issue at 390 rupees per share. Remember, that was the IPO price, and the dilution would keep the stock up move in check. But at the same time, increasing cash balance, increasing growth prospects, and the cash balance after the Rapido stake sale at par with someone like an Eternal and a lot more than Zepto would perhaps provide positive levers for the stock going forward as well, for them to be able to invest in quick commerce and growth too. So those two negating factors keeping the stock in check right now, currently settled mildly lower versus an up move that we saw yesterday.
Okay, all right. Thanks very much for that. Yesterday, Eternal, Swiggy, everything was up about 2.5% as Mangalam said by close. Well, 9-10 calls. Sudarshan, what do you have?
It's JSL. Buy JSL with a stop under 760.
Okay. That's Jindal Stainless. And Mitesh, what about you?
I'll go with a sell on Tata Steel for targets around 153.
Okay. That's Tata Steel from Mitesh. We got about 3 minutes to go for the market open. Let's just squeeze in one more name. There's an initiation coming through on JSW Cement. And Nigel, take it away.
Well, that's right. Equerus, they have initiated coverage on JSW Cement. They have a long rating with the target price of around 167. They point out that the stock has corrected 24% since the issue price, and valuations now at around 15 times or around 12 times its EV upon EBITDA. They appear attractive. You're looking at the forward multiple out there. The factors that they're pointing out, one is the company dominates India's granulated blast furnace slag. That's the GGBS market. They have close to 80% market share in that particular market, and they support it because the group company JSW Steel helps them out with some of the raw material out there. So there are group synergies. Point number 2, the rising infra activity and demand for green products. That's what will boost the GGBS volumes, thereby offering higher margin stability as well in comparison to a normal cement player. Point number 3, JSW Cement is moving into North Indian market with around 3.5 million ton expansion plan, and they're giving them close to around 15-month lead to build scale, efficiency and distribution in the high profit market as well. Remember, that's been a market that's been dominated by players like Shree Cement. And finally, they're talking about the revenue and the EBITDA. They're expecting it to grow by around 18 to 33% over the next 3 years, which will be driven by this capacity expansion and also the steady performance coming in from the GGBS segment. So we'll keep an eye on this stock. Remember, it's seen a big correction from the top. Now Equerus is saying risk-reward could be turning favorable. So that's a stock we'll keep on our radar.
Okay, all right. Nigel, thanks very much for that. Well, 24 points higher on the Nifty is where we're at. Maybe we got time to just put up the Indigo rate at the end of the pre-open session because that'll be one go-to name as we open up and look at where that is landing. It's down 0.6%, but around 5,000 rupees is where Indigo is at. The other one is Keynes, which has seen a sharp correction and a sharp rebound yesterday. So we'll go to that as well. So 2% higher after the 13% move up yesterday is where we're at. So 4,400. The low that it got yesterday was about 3,700. So 37 to 44 quickly. What do we have? First rates coming up in just a bit from now. And we'll look at the Nifty heat map, and then, of course, come down to individual stocks. So 25,870 is where the Nifty is at. 59,300 is where the Nifty Bank is at. And mid-cap index about a third higher. Small-cap index is up about 0.14%. And more up than down out of the gates. But it's just still very, very early and tentative as well as we kick off this Wednesday trading session. Nifty Bank now barely in the green. Nifty barely in the green. Mid-cap index a little bit more definitive with a 0.25% gain. The Nifty heat map, how many up and down as we begin today's session. I'll show you a quick snapshot view. So it's kind of more up than down. Grasim and Trent on one end and Bharti and L&T on the other end of the spectrum on the Nifty 50 heat map. 10 points now in the green on the Nifty. Surbi.
Grasim is up because of that investment they're getting from BlackRock in their renewables arm. And the market's, taking a liking to that. So about a percent, actually less than a percent, 0.7% right now up. Hindalco also is up about 0.7%. So two strong moves from that group. M&M managing a little bit of gain. Trent is up about 0.5%. And then it really starts fizzling out. Nothing much to count here. Geo Financial less than 0.5% higher. Let's see where the pressure is coming in from. Interglobe Aviation down 1% for now. Let's see how the stock settles through the day. Down a little over 1%, 1.2% now. So Interglobe is in focus. Bharti Airtel has lost about 1%. JSW Steel is losing some ground. Titan is lower by about 0.5%. Otherwise, everything is flat. Bank Nifty is absolutely quiet. Large names like HDFC Bank not really providing any sense of direction. SBI totally flat. And ditto for ICICI Bank. So really nothing much is moving. Keep an eye out on Interglobe. Let's look at what Swiggy and Eternal are doing. Stocks are in news. Eternal is about 0.5% lower. And Swiggy, last I checked, was also trading fairly flat. Swiggy is not doing much. Just about 0.5% up. What a quiet start, Nigel.
Well, that's right. But a few stocks, they are bucking the trend in today's trading session. Silver is seeing a bit of a melt up. We've been covering it. I recall middle of this year, when gold was up 40% and silver was up only 15%, they put out a case that probably silver could outperform from here on. That's the way it's played, because from there, silver's up close to around 80%, while gold has put on some weight, but not as much as silver, and that ratio as well has narrowed. So Hindustan Zinc, that's the only way to play it from the listed space. That one's up close to around 2.5%, and Vedanta, because of its holding in Hindustan Zinc, that gets some support as well, and that's why many are a little bit bullish on Vedanta, because it has the aluminium play, and it has the indirect play on silver, and those two commodities could continue to do well. So that explains why those stocks are up. The other few stocks that are doing well, AU Small Finance Bank, there's green out there. They have got the approval from the DFS, the Ministry of Finance, to increase the foreign investment limit in its shareholding. And remember, MSCI, FTSE, they as well track these changes. So that explains why that stock as well is up close to around 2% or thereabouts. JSW Energy, yesterday there was a large trade that got out of the way. GQG Partners sold close to around 1.5 crore shares. And once that's out of the way, you see the stock bounce up a little bit. And in addition to that, they have a board meeting on December 12th to consider fundraise via shares as well as warrants. So participation in that will be something that will be tracked as well. Sammaan Capital, that's up close to around 2%. I think earlier today or late last night, we have the CCC approval that's come in there from the IHC investment in Sammaan Capital. So that explains why that stock is seeing some green after, the kind of correction that we've seen on that name. And on the losing end, though, you have Grow, which is Billion Brains. That's down close to around 3.5%. Seeing some profit taking out there. And as would be mentioned already, IndiGlobe Aviation down 1.5%. The good news is the Nifty is now closer to around the 20 DMA. The bulls will like to see a close, gradually towards the 20 DMA, which is 100 points away from current levels.
Absolutely. And, silver Bs, right? 3% gain on silver Bs at this point. Hindustan Zinc, I think we mentioned 3% higher on Hindustan Zinc. 508 is where that is. Right next to each other, silver and Hindustan Zinc in terms of, a ticker, two names which are both up and about. Tube Investments, I think, is up about 3% as well as is the number one volume-led gainer right now. That'll come up as well. Yeah, 1.3 million shares. I mean, it comes up with 3% gains occasionally, but never on the top of the volume-led gainers list. But it's by far the number one volume-led gainers gaining stock this morning coming through. What else? JSW Energy, some of the bunch of these silver ETFs are all up between 2, 3, 4%. So that's that. Car trade is up about 3% or so as well. 1,600 stocks are higher and about 700 stocks are lower at this point in time. Stuff on the downside. Capillaries, the recent listing is down about 2.5%. Latent View went up 10% yesterday. It's down about 1.5%. Eris was up 10% yesterday, down about 3.5%. So some reversal, some profit booking basically is what you have. Ixigo, for example, went up 10% yesterday. It's down about 2.5%. So these are all reversals. Newland was up 7% yesterday. It's down about 1.25%, 1.33%. But keep an eye out on some of these names because this is very, very initial first rates which are showing through. Aditya Suresh is Managing Director and Head of India Research, Macquarie Capital. Aditya, good morning. Good to have you here. Thanks for joining us. On paper, Aditya, if you can put it that way, right, across sell-side research houses, the view is turned. And most are expecting a better 2026. The reasons are well discussed and well documented. I sometimes wonder how much of that has got to do with the fact that, we've got sort of, we've spent enough time doing nothing and we've seen some price damage, and the fact that the year is turning. So maybe, hoping for a better year ahead, and how much of it is just based on fundamentals and valuations, etc. Because valuations across the board have still not come off. I mean, the premium compared to EMs, etc., has come off a little bit, and those kind of arguments one can make. But on an absolute basis, across the board, valuations are not a screaming buy or anything. So how do you look at things, Aditya?
Prashant, thank you for having me on the show. If I just take you back a little bit, Prashant, so at least Macquarie, our view into this year was far more cautious than where the market view was at. And it was pinned on a few aspects, right? And it largely was on kind of where expectations were at for earnings, right? And across different sectors. one of the key points we were trying to make was that, we're going to see these cuts for us to kind of absorb and digest as a market. Now, through the year, we've kind of seen a lot of that kind of come in. In our recent piece, Prashant, now there is an element of looking out 1 year at a point in time. We kind of do these outlook reports, but the point we're trying to make is that when you kind of go back to the same framework, today where we are from an earnings perspective, I think there is an element of support here, right? Because the cuts already largely reflected in the numbers is our expectation, or at least that's our sense. And to the extent that's correct, then we're really going to be coming off a phase where last year, for example, of fiscal 26, basically had no growth, right? Your revenue growth was about 5%, so GDP minus. Underneath that, you've seen some margin erosion. So PAT growth has been tracking below that 5%. In response, you've seen the cuts. But to the extent that now we're feeling more optimistic and comfortable with where expectations are at least the broader dynamic here is about us getting back towards that mid-teen pace of growth compared to it being absent, right? So you're trading at this high valuation and no growth. And when you then think about that versus kind of broader emerging markets, you had seen this phase where markets like Korea, Taiwan, all these things, estimates are being meaningfully revised upward, right? And so somewhat kind of counterintuitive perhaps, but you had this high PE multiples for India with no real kind of relative growth premium, which has been a fairly problematic dynamic for India as a market to kind of work through. And the point we're trying to make here is that we do feel that earnings coming back is going to then mean that foreigners also potentially come back to India as a market. That'll be a support factor here. But again, it's the entire theme about kind of this growth recovery. So I think things have changed, Prashant, in terms of what's in expectations. Feeling more comfortable about kind of what's in expectations for fiscal 27, fiscal 28, and that underpins a lot more of that positivity. Underneath that, in terms of stocks, it's very selective, bottom up. There's no specific sector tilts necessarily.
No, well put, Aditya, and thanks for explaining that. No, I was just, no one wants another tough year. So sometimes at the end of the year, you're just, rooting for a better 2026. But there are reasons to do that as well, as you explained. And let's, I guess, get into some stocks, sectors, etc. Surabhi.
Yeah, absolutely. Aditya, hi, morning. I just wanted to go back to that earnings point before we talk sort of more specific names. You're saying, and that's an expectation we've had for several quarters, right? We start the year with expectations of 12-13% growth, and then those expectations are tapered down. So now, halfway down the year, what is your earnings projection for this year, and more importantly, FY27?
So I think fiscal 26 in itself, just this year, I think is less relevant from a forward-looking perspective for markets. I think just to establish the point, if we start there thinking about, say, fiscal 26, we're going to get some nominal GDP plus X kind of EPS growth. That's clearly not been the case, right? So even revenue growth in nominal terms has been below GDP, and underneath that, you see that margin erosion comment. So it's tracking at, say, maybe 2-3%, depending on kind of which index you're looking at and how you're adjusting for one-off items. Looking at fiscal 27, fiscal 28, when we do the bottom up. And thinking about kind of what growth is, at least we're forecasting, we're in that, say, mid-teens kind of a pace of growth. We're not being in that kind of that trajectory for some time now. But you're correct that there is a bit of a departure in terms of the spot comment is one where growth is really, really anemic, and the expectation is that this recovers. But when you then do that across different sectors. Take financials, for example, like our team, the financial side, they're speaking about credit growth in the high teens. Maybe you get some margin expansion as well. We'll see. That alone is, say, for example, 30% of MSCI India. The IT sector, at least our analysts are a bit more optimistic than where the street is at on revenues and margin. So when you're going to do that and go through across different sectors, we feel a bit more comfortable. And that is a meaningful departure from where our mindset was 12 months back.
So this mid-teens growth for next year, FY27, broadly speaking, if I were to ask you, what will lead it? Financials, like you mentioned. What else? I mean, just looking out next 12 to 14 months.
So it's just purely from an aggregate perspective. It's largely financials. Industrials is a big part of the story as well. Materials is part of the story. With the consumer names, it's more revenue and margin as well. There's this operating leverage comment, which is kind of embedded. Healthcare is a bit more idiosyncratic. Telecom is going to be some really good headline EPS growth still, because that sector, the kind of interest burden is still high. And so as this operating leverage kind of comment plays out, then you still see that growth coming through. But broadly speaking, we are feeling more comfortable in terms of what's in expectations right now.
Okay, all right. Hi, Aditya. Good to see you in. But short point being, going by all that you said, you're saying that 2026, we should be leaning more towards 30,000 rather than 20,000. I think that's the big takeaway, right?
Well, that was the one-line kind of catch-all kind of comment. But and that wasn't our mindset 12 months back, right? So we're far more kind of cautious. And just to kind of preface this a little bit more was that when you take this back to even Prashant's comments about valuations, the point about valuations still holds that in absolute terms or in relative terms, India as a market is still excessive when you look at it on its own. But the way we think about that valuation comment itself on, say, the next 12 months is that to the extent we are correct that foreigners are going to be coming back to India as a market, and to the extent that domestic liquidity is going to hold, it's almost as if then the only clearing function is then the IPO side, right? But overall, on balance, if those two aspects are kind of in our favor, then I think these multiples could further expand despite the high starting point.
Okay, all right. Let's get into a couple of sectors then. The EMS space, that's gone into a bit of a funk actually. It was the big theme, maybe getting into 2025. But this year it's had its share of problems for a couple of companies. You all believe that things are ripe, it has a longer runway, and things will improve from here on? If you could tell us what's your view?
Yeah, so our analyst who covers the EMS stocks, so he's still optimistic on the likes of, say, for example, Dixon, Avalon, these type of names. It is still coming back to that dynamic where, at least when you have this thematic which is at play, but I think the broader dynamic is that when you think about this as a combination of growth, returns, and free cash flow, all three dimensions are kind of working well for that sector, at least in our bottom-up estimates for our analysts. And so that still keeps us optimistic on selective names.
Got that. I hope this is what you're saying is absolutely correct. Talking about the paper supply, right, which is coming through. Akash Prakash in an article yesterday wrote, well, that's one of his caveats. He also thinks it's going to be more constructive in 26 over 25, but with caveat that investors regulate themselves with regards to the paper supply which is coming in. And by the way, talking about paper supply, I think Meesho listing today, it's a big one. And I'm being told that there are some visuals coming in from the exchange, and we have the MD, CEO, the founder actually speaking at the Meesho listing. Maybe we'll play, show some shots and what's happening there. There's one more listing, Acus, which is also an interesting company in the defense aerospace arena, which also got subscribed pretty heavily. Just your own thoughts, Aditya. There are various ways to cut this, right? Equity issuance as a percentage of market cap, and you look at where this was in previous market phases, and where we are now. Some say, well, it's at a point where it can overwhelm the market. But of course, I mean, the fact is that one important cohort, which is FIIs, are kind of missing out of the picture. So just your thoughts. Is it likely, if the supply stays so strong, that it could overwhelm markets?
I think just on the supply in itself, the one comment I'll make is that there is a bit of a red herring comment which I think we're missing, which is that a lot of the supply is coming in with the promoters, the PE, VC, predominantly cashing in, right, rather than being used to kind of being deployed towards growth capex. So that's a red herring comment, and obviously kind of all that is in response to these valuations which are available in the market, which are rich. So having said that, I think the broader dynamic is that, so to the extent that we have domestic liquidity holding at current levels, and to the extent foreigners did come back to the market, Prashant, as you kind of mentioned, and at least that's our expectation as well. then India, which has been this roughly about a $20 billion IPO market this year, last year, conditions would still support that. We'd much rather see the capital being deployed elsewhere and more towards constructive purposes on, say, capital formation. But having said that, yeah, I mean, so could you support $20 billion of activity in any given year, even next year? I think the liquidity supports it.
Liquidity supports that. We'll see how this one plays out. By the way, do you have coverage on Indigo, Aditya?
So, Macquarie, we don't cover Indigo, Prashant. We do cover the OTAs, so I can maybe speak in that lens, but Indigo is a stock which is not in our coverage.
What about the EMS space?
EMS, we just discussed it. That is an area which we cover, covered by different analysts on the team. We are optimistic on those names, despite the headlines which you've seen on one of the players in the past couple of days. We're still optimistic on the growth headroom which these companies have, margin expansion. So it's a mix, right? Growth, returns, and free cash flow, all above 20%, at least on those vectors, is our outlook.
Aditya, let's then round it up with a sector that you're really optimistic on, and that's financials. We've briefly touched upon it earlier. But that's a very large universe. So leave us with a slightly narrower approach in what part of financials, lending, non-lending. And then these capital market plays are so interesting. They created a lot of wealth, but now they're probably among the most volatile parts of the market because of evolving regulations. So just tell us, what's your order of preference within financials?
So our analyst who covers financials is Suresh. So he is still fairly selective in terms of his preferences. And so it's still more the large private banks. So that there's a bit of that, let's say, quality bias, safety bias, if I may, within that comment. So he's still more the private banks over the public sector banks. He's feeling still more constructive on your HDFC and ICICI Bank. Incrementally a little bit more optimistic on maybe NBFCs and insurance as sectors. Capital markets, that's a gap in our coverage. So not really making a specific comment on that, but these are good operating leverage businesses, right? So you can see how the changes in kind of whether it be regulations or be just volatility on a daily basis does impact that sector quite a bit. But if I rank sort, it's private banks, NBFCs selectively, then the PSU banks, at least for our financials team.
Okay. All right, Aditya. We will leave it on that note for this morning. Thanks very much for joining in. Good to get that perspective. And now wish you season's greetings and look forward to more conversations in 2026. Thank you for joining in. Well, with that, let's quickly check what's happening on the screen. And yeah, it's still flat, but the bias is a little positive now. So that's the good news. Nifty's managed about a 60-point gain, and we are at the morning highs. So let's see. Bulls trying to fight back 25,900 now. IRB Infra is working, very well. Last I checked, it was up 4-5%. We've got the toll collection data for the month gone by. Vivek, how does it look?
Well, that's right. So, the toll collection data, what's essentially transpired is that come year end, there's actually been a significant jump up as far as traffic growth is concerned. And what the company has told the exchanges last evening is that all three of the entities, which is IRB Infra, the public InvIT as well as the private InvIT, altogether have seen November toll collections at close to 716 crore, indicating that there's been a 16% jump on a year-on-year basis. Now, along with that, the management committee too is quite strong in terms of how they are expecting toll collections to go ahead. They're saying that the year-end holiday traffic boost and sustained nationwide economic activity are expected to further support growth in the coming months. Along with that, remember, IRB has taken pains to go ahead and explain to investors over the last few weeks that they are no longer just an EPC company. In fact, they will now exclusively focus on BOT bidding, which they believe should aid margins as well as the growth going forward. IRB on the back of that higher in the session today.
Okay, all right, got that. Thank you for that, Vivek. So IRB holding on to a gain of almost 3% now. Let's move on to our next guest then. And we're putting the spotlight on IKS Health. We have Nithya Balasubramaniam, whole-time director and CFO at IKS Health, joining in to take a couple of questions. And of course, we want to get some clarity on three key focal areas: the company's growth and expansion strategy for 2026, the partnership with the Google Cloud, and update on the integration and cross-selling to Acuity customers. Acuity is a company that they had acquired a few years ago. Nithya, good morning. Great to have you in. Thanks very much for joining in. So I'm going to start with the most interesting part of it all. and that is AI, right? And it seems that you folks are integrating agentic AI with your operations as well with this Google partnership. Tell us more. It's an exciting time. But in terms of, the real operations, what it brings to the table, the costs of, doing this agentic AI integration vis-a-vis the returns, what are we looking at over the next couple of quarters?
Hi, good morning. So AI and investments in technology happens to be the most strategic vector for IKS. I think we have been very consistent in talking about this in our earnings calls as well. In fact, if you look at our technology spend, it's inched up quite significantly, now touching about 5% of revenues. And I actually foresee this continuing to grow meaningfully as well. If you look at our AI investments, there are multiple use cases some of them are live and some of them are, of course, still in the lab. I'll talk about a few that we are most excited about. In autonomous coding, for instance, there are 2 use cases in two specialties that are already live, and we are now trying to expand that to other specialties as well. In terms of prior authorization, or what we call patient financial clearance, where you need certain permissions from the insurer before you can even see a doctor or be prescribed a certain treatment. Again, we have pushed several AI use cases and achieved very high levels of automation. And the last but not the least is the agentic AI platform that we have launched on Google Cloud, which is actually able to connect automated workflows across tasks. The reason this is unique and important is because when you're able to connect these workflows, your ability to maximize for what the customer wants, which is to be able to get the right revenue for the right care that's delivered and to minimize costs, is much higher than if you're addressing individual tasks.
Sure.
So yes, we're very excited about this.
Sure. So you said that your current spends on technology are at about 5%. And they're likely to go higher. Give us some sense of, how that scale up is going to be and how that starts and by when it starts feeding into margin. I mean, you did really well on margins, even in the quarter gone by. You're at about, 31% ballpark now. So as some of these AI efforts mature, how is the margin profile going to improve? I mean, we're just trying to understand cost-benefit analysis here. Some projections will help.
So I won't be able to give you future projections, but what I can tell you is what we have delivered in the past, right? So if you go back and look at legacy IKS financials, you'll realize that from the FY20 through FY24 timeframe, when my revenues grew 25% CAGR, my employee cost in the same timeframe grew only 8%. And the non-linearity is entirely due to the technology investments and the automation that we were able to deploy in the various features. So with AI, of course, we're hoping to see similar kind of leverage, but that'll happen as we put these products out in the market.
And the tech spends go up by how much from the current 5%?
So it'll anyway grow right alongside revenue. I don't see this percentage of revenue coming down. We might even step it up depending on some of the new features, etc., that we're working on the platform.
Okay. So let's talk about, how the overall business is shaping up. We had a brokerage report out a couple of days back on the company, and that note sounds very, very optimistic. I mean, just to quote, this is Nomura. Nomura is saying that at a CAGR level, you can probably do 16% revenue and a 32% EPS CAGR going up to FY28. Do these sound like, fair calculations and fair assumptions to you?
I really cannot speak to what is there in the analyst report, but I'll tell you what we are guiding the street, which is that, one, we do want to be able to grow several notches higher than the market growth itself. The outsourcing market growth in our space is expanding at about 12%. So yeah, several notches higher than that. And in terms of EBITDA margins, our guidance has been that the early to mid 30s level is what is sustainable for us. We're already touching those levels, and we're comfortable saying that in the near to midterm, we should be able to maintain these margins. When it comes to PAT or earnings growth, yes, it should grow faster than EBITDA because we do see significant cash generation and therefore our ability to get to zero net debt level in FY27 itself. So you'll see that impact in earnings.
And we'll ask you that one question that we always ask, but then, you can imagine why we ask it. because there's just so much of rhetoric coming out of the US almost on a daily basis, right? It's one day it's H-1B visas, the other day it's Indian rice. And I mean, you are heavily dependent on, of course, US customers. So all is well or anything? I mean, anything that you need to tweak or strategically change in terms of how you're servicing these customers as we enter the new year, given the current White House dispensation?
It is fair that a lot keeps happening and a lot makes the news as well. But I think so far, if you look at what specifics that they've talked about, so H-1B visas, for instance, has zero impact on us because that's not a business model. Whatever talent we need in the US, we actually hire in that geography. Right? So H-1B visas do not have an impact. I think at some point of time, they were talking about a potential act where they might increase tax for firms that are outsourcing.
Yes.
Outsourcing, and again, that again did not see any support. So no impact. But broadly, I think what they're trying to do is reduce healthcare spends, right? If you look at the US, they're spending almost about 20% of GDP, and they really need to do something to bend the cost curve. So they have come up with measures to reduce Medicaid spending by quite a significant amount. Again, for us as a business model, our customers are not exposed to Medicaid. It's more Medicare and commercial payers. And therefore, that impact is rather insignificant. But that being said, given these broader headwinds, it's if anything, it's maybe a little easier for us to convince our customers that, hey, be a part of the solution. Here's one way for you to actually shore up your P&L in light of all the headwinds that are playing out.
Yeah. Nithya, morning, Prashant here. Sorry, I just very briefly, this entire AI bit, right, can it become like a competitor internally for you? It helps in efficiency, etc. But could it cut down per customer billing rate?
So I don't see that happening in the near to midterm. If you look at how we have always priced our product and services, it's always been based on the outcomes that we want to deliver to the customer.
But the customer on the other side, if they realize that you're getting a lot more done with a lot less, they're going to want that, right? They're going to want that savings across.
We're not having those conversations, Prashant, so far. I think while AI is the pace of change is quite healthy, we've always been deploying tech, right? You go back and look at my 18, 19-year history, we've always been deploying tech, whether it be machine learning, robotic process automation, and the model and the way that we actually deliver our services and the way we price our services, we have been able to take leverage of that, that tech deployment onto our P&L. Of course, it's very difficult to predict what will happen 5 years from now, 7 years from now. But I think in the near term, based on the conversations that we're having, for a large part, we should be able to take benefit of technology. In some cases, yes, I think it remains to be seen. Over a period of time, we'll see how this sector matures and shapes up. Maybe there are some parts of efficiencies of technology that we have to pass along. We're not there yet. But again, we're not shying away from that either.
Okay, got that. So evolving situation, but at this stage, at least, as we speak today, you're not foreseeing that happening in a big way in terms of per customer billing rates getting impacted because of all this deployment. Thank you very much for joining us, Nithya. Appreciate you coming on here on CNBC-TV18. We come back on the other side. Anupam Rassayan Management has signed a definitive agreement to acquire a US-based specialty chemicals company. We have Gopal Agarwal from the company joining us on the other side.
"26 years of CNBC-TV18. "26 years of CNBC-TV18.
It's a green-looking screen. The Nifty is holding higher. The number of stocks advancing are much more than the number of stocks declining. The ratio right now is 4:1. Haven't seen that sort of a ratio in many, many trading sessions. Let's hope it holds. Well, let's focus on Anupam Rassayan. The company is in focus as they've signed a definitive agreement for acquisition of 100% equity for around $150 million in US-based Jayhawk Fine Chemicals. To discuss this, what's the way ahead, what are the benefits of this particular deal, Mr. Gopal Agarwal, the CEO of Anupam Rasayan, joins in. Hi, Mr. Agarwal. Good morning. Good to see you, Ben. And thanks a lot for joining in, and congratulations on this large deal. Well, before we come to you, Mr. Agarwal, just want to focus on, what we're going to be talking about, the synergies from this acquisition, what will the combined entity look like, and are there any cross-selling opportunities as well? But Mr. Agarwal, let's get off the blocks with the first point then. Explain to us the deal structure. You're investing, I think, close to around $40 million via a wholly owned subsidiary. The rest of it is coming from the investment company, right? Because you're subscribing to the Class B shares. What are the commitments you have made to the investment company? If you could give us some color in terms of dividends, any outgo, IRR targets as well.
Well, first of all, thank you, Nigel, for having us, on the channel. It's one of the, I would say, big milestone, in Anupam's history. It's a pretty bit transformative kind of a journey, for us, to become a global specialty chemical company. And hence, it's a pleasure to be, on your channel for this. See, as far as the structure is concerned, let me kind of clarify. In all, as far as the enterprise value is concerned, it's 134 million. Plus, the company has 16 million of cash, so which would mean that we will end up paying 150 million, for the transaction. Of this, currently, we have multiple options. One of the options which is under consideration is wherein, the company will look at investing roughly, let's say, 40 million, out of Anupam. And then we will look at maybe, let's say, anywhere between 100 and 110 crore coming from a large, very large global financial institution, which has a AUM of over $100 billion. Idea would be that, we use this money, to kind of acquire the company, and maybe at appropriate stage, look at some kind of a capital raise or otherwise to kind of fund this back. So this is how we are looking to kind of fund the transaction. This would ensure that we get 100% control over the company, because the investment which will come from the global institution would not have any voting rights. So this will allow us 100% control and consolidation of the company.
Okay, and the investment company would be?
Currently, it's under discussion. As I said, we have multiple options, and this is just one of the offer which has come to us. So maybe at the appropriate time, we will share the details of the same with you, Nigel.
Okay, all right. So we'll have to wait by in terms of, how things shape up on that front. Give us a few more details. How much of this funding will be via debt? And I believe you're saying that there will be margin improvement. But the acquired entities' margins actually are relatively low in comparison to what you're doing right now. So give us some color on that front, debt and margin outlook.
So as I said, currently, we are looking to raise roughly, as I said, roughly around 40 million. Rest would be through a quasi-equity structure, which will come from the global investor, which we are talking about. As far as the margins are concerned, let me share a bit of a kind of a background, on this. For us, this is something which is clearly a step towards nearshoring, which is one of the key thematic, which most of our customers have been looking for. It allows us basically to access some of the, I would say, niche chemistries, including oxidation, Suzuki, Exo, and others, which currently, Anupam does not have. And, there are certain chemistry which, let's say, are the expertise of Anupam. So that way, it's a big complementary in terms of chemistry. Similarly, if you look in terms of segment, Anupam has large agro presence, which is roughly around 55-60%. Performance material, which is a big kind of a segment which we have been looking to, let's say, foray into, currently is only 10 or 12% for us. While as Jayhawk, the entity which we are acquiring, almost 70% of their what we call revenue is from performance material. And this goes into niche segment like aviation, semicon, electricals, which are a very, I would say, kind of a growing segment. As far as the what we call customers are concerned, again, there are some common customers, and we'll also get access to a lot more, I would say, large global customer, which will help us kind of expand both, I would say, cross-selling, as well as, help us probably be a lot more efficient, in terms of that synergy benefit, which will allow us to kind of expand the margin, from the current levels.
Okay. Gopal, hi, morning. Congratulations, Prashant here. Two questions. Does it have in the chemistries and what it produces, this company produces, does it have like a dominant market share in any niche segment?
No, Prashant. So basically, as I said, as far as the high purity process or chemistry is concerned, this company Jayhawk has I would say, a kind of a monopoly position, and have customers who have been there with them for decades. So I would say it's a kind of a annuity, business which they have been able to build, given the expertise of the chemistry, and what you call some of the processes which I would say are unique, to this company, which has been developed over a period of time by the team.
High value performance materials, I think it's about 12% of your revenues currently, right? Post this acquisition, what will that number be at, and what are margins in this segment as opposed to the rest of the business?
So, to answer the first question, I think post the acquisition, roughly, the combined entity will look like we will have roughly 40-45% coming from agro. Almost 35% would be performance material, and a balance would be personal care and pharma for us. As you rightly mentioned, see, performance chemicals is one of the fastest growing segment, and given the end application, which is in aviation and semicon, which is again are a hugely growing sector, the margins are going to expand. And the way we are looking at it is not to be a what you call competitive supplier, but more look at providing integrated supply chain solutions to our customer, which will help us expand the overall margin. So what we are talking about is a combination of onshore and nearshore, which will ensure that the margins going forward will only increase.
What are the margins now, Gopal, on this segment as opposed to the rest of the business?
So I would say roughly it's around 20%. But yes, as I said, given the synergy and integration benefit, we do believe I think we should be able to kind of achieve or come closer to the margin which Anupam enjoys, which is roughly around, let's say, 25% in the near term.
Okay, and over what period? Because that was one of the concerns, that your margins, Anupam, is closer to 28%, and this entity that you're acquiring is closer to, like you said, 19-20%. Over what time period will the blended margins stabilize of the consolidated entity? Over what period will they come up to 25%?
I may not be able to kind of tell you the specific, let's say, in terms of the years, but I think it would be, I would say in the near term, because Surabhi, we have plans of kind of expanding our portfolio, at Jayhawk. In fact, just to share with you, the current plant has almost 3 million, what you call square meters of land. Currently, only 20% of that, I would say 15-20% of that is used. And in fact, that has been one of the biggest driver for us as well, because it allows us to expand our product offering, to other customers, from there, and we can really look at expanding, I would say both the product offering as well as services to our customer, which will ensure that, we are able to kind of grow to the margin which currently, let's say, Anupam enjoys much faster than...
Sure. And you also mentioned that this performance chemicals is a high growth segment. So again, sustained just growth, I'm now talking top line growth for this segment, which is going to be almost 35% of your operations. What will that be going forward? So, I mean, I'm trying to understand the advantage at the headline, the revenue level for the blended entity. What should be a sustained, revenue growth, which one can expect immediately first year onwards after integration?
So as I said, I may not be able to guide you as far as the company is concerned, but if I was to talk about the market, the segment which are aviation, electricals and semicon are something which are growing at a pace of almost, I would say, anywhere between 20 to 30%. And our endeavor has always been, to kind of grow bigger than or larger than, what the market is growing. So from that perspective, as I said, this is something which is going to be a big growth driver for Anupam, and I would say Anupam and Jayhawk as an entity together.
But you'll have to increase debt. Like you mentioned, that the funding is happening, partly by equity and partly by quasi-debt. So while you go for growth and complementary, business verticals, overall, how much will the debt go up by? I'm now talking consolidated debt. Where is it right now for Anupam? And over the course of the next 1 year, say, how much will it go up by?
So two things. One, even at Anupam level, Surabhi, currently there is practically no term debt, number one. Number two, as I said, the entity which we are acquiring, is sitting with a 16 million of cash already, as a part of the deal itself. So yes, in terms of specifics, we will be sitting with the management and, kind of come back with the exact capex plan and all that. But I can assure you, it is not something which is going to be a big number, both in terms of capex and debt, which we are looking at it. Because I said a lot of it, will be driven just by the synergies, which both the companies will be able to kind of work together and provide. Also, let me add, another driver for us, in this deal was the management. And please appreciate in any CDMO business, people are the biggest asset. You have Jayhawk, which has been, entity which has been running by the existing management, I would say for almost last over 2 decades. So we have a team of experienced people who have, I would say, more than requisite knowledge of the chemistries and relationship with the customer, which will ensure that, yes, all we need to do is be the catalyst, to them. And growth is something which is, I would say, is something which will be our way much sooner than otherwise.
All right, we've got Gopal. We'll leave it there. Thank you very much for joining us. Really appreciate your time here on CNBC-TV18. Well, you got two big listings on your screen. One, of course, much bigger than the other, but both interesting. Meesho is starting in the pre-open 45% higher. I think we've got market regular trading on both with the bell ringing and just about now. There you go. What do we have? First rate should start to appear on both in just a bit. There you go. 166, 167 on Meesho. That's a 50% jump on top of what they sold the IPO at. And on Acres, we still are awaiting rates. So we will just look at that.
About 16% up for Acres as well. So even that is a good listing.
Yeah.
143 on Acres, but Meesho really takes the cake, steals the thunder. And that's the one thing that I think investors really liked. The issue was oversubscribed almost 80 times across categories. I think everyone said that they left a fair bit on the table. The pricing was not too aggressive. And maybe that's what they're getting rewarded for now.
Absolutely. And I think it's a phenomenal debut for Meesho. Really, the year of so many consumer tech companies coming to the market. Some not so much consumer tech, but basically new age businesses which really build scale, size. So you've got both coming to the market. By the way, even Acres, in that sense, is new age because it's building for a sector which is where there's not too much manufacturing capacity. I'm talking about manufacturing for the aerospace industry. Although it's, of course, compared to Meesho, much smaller issue. I mean, in that sense. But good day in terms of market opening. I think there is one more listing, but much smaller, and maybe we can go across to that a little later. But that's the debut which is coming through on Meesho and Acres. Vinay Rajani is with us with a quick check on markets and where things are at. 50 points higher, by the way, 25,885. Vinay, how would you look at things? What are the trades?
Good morning. So there was a rebound from the lower level yesterday. 50 days EMA was the support, and exactly from that level we have seen a nice rebound in the Nifty. However, still Nifty is placed below 5, 10 and 20 days EMA. So there are a cluster of resistances looming around 25,950 to 26,000. So still there is an uncertainty as far as Nifty is concerned. But yes, there was a good rebound in the mid cap, small cap segment after a healthy corrections from the recent highs. So yes, breadth has improved a bit. We need to see whether we are able to cross the important resistance in the coming days or not. So it is very important that Nifty should close above 26,000 to confirm the resumption of an uptrend. Unless that happens, stock specific movement will be there and choppiness would be there in the Nifty. So yesterday's low, we are asking our traders to keep a stop loss. 25,700 odd level should be the stop loss in long position. On the higher side, we are waiting for 26,000 to be taken out. Once that is taken out, definitely we can expect good movement on the upside in the Nifty. So yes, right now consolidation is going on with strict stop losses. One can remain stock specific bullish.
Okay, all right. Let's get to your stock specific calls then.
Yeah, so few large cap stocks are still looking strong and sectors are also performing. So one of the sector which we like is the auto sector. So from the auto space, Eicher Motor looks very strong on the chart. So around 70,200 one can go long. I would suggest a stop loss is 70,100. On the upside, I'm expecting a short-term target at 7,350. Second stock is from the NBFC space, the Chola Finance. So Chola Finance has been a resilient stock and this entire space has been performing well. So NBFC Chola Finance is looking quite strong, and 1750 is the entry level around which one can go long. 1720 should be the trading stop loss. On the higher side, I'm expecting a target of 1800.
Okay, all right, got it. Thank you very much for that, Vinay. We'll take a very quick break on that note, come up on the other side with Manisha Gupta and the latest commodity cues.
"26 years of CNBC TV18. 26 years of CNBC TV18.
Welcome back. So the equity market has picked up some momentum, green on the screen. Let's figure out what is happening with the commodities. With commodities, as usually the gold or silver on the screen. Manisha, what's the latest?
Well, I'm talking about all the record highs that we've seen within commodities in this year, and that is silver, gold and copper in that ranking there, with the kind of returns that you've seen in 2025 coming in from all of these. So that is what we've done, especially in case of silver. 4% of gains in the overnight markets. We are up by 19% for the last 1 month. And in this year until now, it's 111% in dollar terms. It is 120% when you look at silver in Indian rupees, counting in the rupee depreciation as well. Well, when it comes to silver, it is about silver being a dollar index, which is down 8.5% in this year. That clearly has been a supportive factor. And then silver added in the US Geological Survey list of critical minerals clearly has had silver surging on the higher side. The market focus also is on the Section 232, which is being worked on right now, with the expectation that you could see a result of this coming in next 4 to 6 weeks. And if this comes in positive, then you could be looking at silver surging even higher from here on. And then silver being considered for an inclusion due to import independence there. Also, when you look at the physical buying, that has been very strong in the Indian markets. When you look at the global silver ETF inflows, that has been on the higher side as well. So last month was 487 tons of silver ETFs being bought in the global markets. This month, till time, it already is 475 tons. So that tells you that people are not leaving it out. And at these current levels as well, there are investors when it comes to silver. The central bank acquisitions, the industrial demand, whether it's for data centers or solar panels, also has been supportive. And then the supply deficit is expected to continue in 2026 as a 6th straight year has been supportive for silver. And markets are pretty bullish going forward for silver as well. We have $65 and $75 an ounce of forecast coming in for the next year. Gold prices then, and we are trading above $4,200 an ounce for this one as well. 43.80 is an all-time high, and gold has been holding around those levels for some time now. Gold actually has hit 45 times record highs in 2025 till time. Gold also has seen a 60% of gain in this year till time. China has added gold to its official reserves for a 13th straight month in the month of November. ETF inflows, robust physical demand, all of that has been supportive for this as well. But what is the next gold is copper, because we've seen all-time highs overnight into this one. Copper has hit an all-time high of $11,770 a ton. For the US markets, we saw an all-time high in the month of August therein. Prices are up by 34% in this year till time. Copper stockpile in the US is something that has been supportive. And apart from that, it is China saying that the domestic growth is what they are going to be prioritizing in 2026. It also has to do with strong demand coming in from power upgrades, also from computing power, from EVs, that will keep the copper prices supported there. And then it is about the CITIC Securities, which says that copper prices, once they come to $12,000 a ton in next year, that is when you will see new investments coming in for mining. Citi, I was talking to them yesterday, Max Layton told me that $13,000 a ton is what their best case scenario is in the next year. So from these current levels as well, 10 to 15% of gains in copper is what they're working with in the next 3 to 6 weeks.
Okay, all right. Thank you for that, Manisha. We'll take a quick break on that note, come up on the other side. And Lata will be in conversation with Enam Holdings, Sridhar Sivaraman, on the impact of lower nominal GDP on earnings and what stocks may shine in 2026.
"26 years of CNBC TV18.